it was the Black Monday where Dow Jones just minus 1,000 points right at the open. So that day itself, right, I watched my portfolio and I froze in horror. I was like, again? Oh no.
Hi, I'm Philip Teo, your host for Online Trading Summit, and I'm excited to introduce to you Jay Tun, our presenter for this session. Jay is an independent trader who seeks to educate through his own trading experiences following the start of his own trading journey at the age of 22. He's a self-taught trader who has read more than 200 books on trading and investment since college and created his trading methodologies modeling after several successful veteran traders that he has learned along the way. Jay has since amassed about 10 years of trading experience while trading different market conditions with consistency. Of the many disciplines in trading, Jay specializes in trading options, swing trades on equities, currencies, futures, and CFDs. Hundreds of retail traders across Southeast Asia have benefited from his swing trading program since 2015, and Jay is also actively involved in speaking engagements across Southeast Asia, namely Singapore, Malaysia, Thailand, and Vietnam.
So I make use of simple, easy to apply technical analysis framework to choose, okay, which are the areas of demand, which are the areas of supply. And when prices comes to these areas, what kind of reaction am I waiting for before I decide whether to get in or not? All right. So we wait for the right timing. We wait for the right opportunity. So on the chart itself, right? So this was a chart that I just captured yesterday, and this is of the E-mini S&P 500 futures. So the price performance is very similar to the underlying S&P 500 index itself. So on my chart, right, you can see three things. You can see very clearly three things, and this is the technical framework that I use for myself. And I know some of you, right, are using Fibonacci, you are using Andrew Pitchfork's Gann's diagram. So I'm not saying that those tools don't work. It's just that for myself, right, I like things that are very effective and very simple to apply. And straight away, there is no like what sometimes works, sometimes don't work.
Broad market seems to be rolling over or showing signs of going to a lower low. So will that stop you from getting into that particular trade in that very strong sector itself?
Yes, especially if the stocks are the index stocks. So like for example, McDonald is part of the Dow Jones 30. So, and yesterday we know that the Dow Jones have tumbled 3.5%. So naturally, McDonald is going to get affected and be brought down together with it. So 85% of the stocks, right, they will generally follow the direction of the market. So the market, right, is also another filter. Like if let's say it's rolling off, it's topping out, and will I, hold back on trigger? Yes, I will do so. So there's number one, I may stop looking at entering completely. That's number one. Number two, if I still very optimistic about it, like for example, Zoom, you can see from my sharing just now, Zoom, the pricing are very stable. It is not going down. So what do? You want to go in, still can, even though it's not advisable, you want to go in, still can, but go in with a very, very small sizing. Because in the event that it rolls over together with the market, at least the exposure, your damage is limited.